So, in the previous class we discussed about the earning sensitivity analysis and as well as dollar gap analysis, and in these two particular cases what we have observed, the basic objective of the commercial bank is to manage the interest rate risk to maximize the interest income. But what we have seen that whenever we are talking about the limitations of the dollar gap, the major limitation is the dollar gap analysis or the earning sensitivity analysis do not consider the or they do not take into account the shareholders value maximization. That means, we are not talking about the net equity values or the net worth of the banks, how it is going to be affected. We have mostly concentrated on that how this change in interest rate is going to affect the interest income, and those particular income how we can maximize by the adjustment of the assets and liabilities. That was our basic objective whenever we are talking about the dollar gap or the earning sensitivity analysis. But in the true sense, the another objective of the commercial bank is also to maximize the shareholders value, or in general sense we can call it the net worth of the commercial bank should be maximized. So, whenever the net worth concept comes, the dollar gap analysis or the earning sensitivity analysis, whatever we have discussed, that basically has not trying to analyze the significance of the valuation of the shareholders or the equity valuation of the particular stock or particular bank stocks, which basically is very much required for the maximizing the shareholders value. In this context, we have another concept we use, that is called the duration gap analysis. So, in today's discussion, we will be covering up what do we mean by the duration gap and how the interest rate, duration gap and value of equity are linked. So, if we know the duration gap, so if there is a change in interest rate, then how it is going to affect the value of equity. So, if the value of equity gets affected, then what kind of strategy we have to adopt to minimize that particular risk or to increase the value of equity in that particular bank. So, this is today's topic or today's discussion what we are going to make. So, let us discuss first what do we mean by the duration gap. The duration concept already you know, in the fixed income securities part we have discussed this. The duration is nothing but a weighted time average to receive the all cash flows from the financial instrument. So, here what we have done, that we have the series of the cash flows which are available, and in the series of the cash flows we are trying to basically find out the present value of that, then finally we get the market price on the basis of the maturity, then we get the weights with respect to the present value and as well as the market value, and that particular ratio can be multiplied with the time to find out the weighted average of that particular or this weighted value of that particular time. Finally, we take the summation of that of all those periods whatever data we use, then finally we can calculate the durations. That already all of you know, depending upon the maturity we can find out the duration, and duration and maturity are positively related. If the maturity period is more, then obviously their duration also will be more. But if you talk about the duration of a portfolio, duration of a portfolio is nothing but it is a weighted average of each of the assets duration, with the weights being the proportion of investments of the funds allotted to each asset. So, if you know the duration of each asset, then how much money is basically spent or invested in that particular asset. So, that on that basis we can give the weights, we can assign the weights, and finally, the weighted average of all those durations of all those assets if you calculate, then the duration of the portfolio can be considered, can be calculated. And whenever we talk about the duration gap of a commercial bank, the duration gap of a commercial bank is nothing but it is the difference between bank's assets and liabilities, basically duration of the bank's assets and duration of the bank's liabilities. So, if you can calculate the duration of bank's assets and duration of bank's liabilities, then your what we can say that the bank's duration gap can be calculated. So, if you see that in general case, then how it is basically calculated. This duration gap is basically is a measure of interest rate sensitivity that helps to explain how the changes in interest rate affect the market value of the bank's assets and liabilities and as well as the net worth. So, the net worth is nothing but, already we know that the net worth of the bank of any organization is nothing but the assets minus the liabilities, which is nothing but the owner's equity. So, whenever you talk about the assets minus total assets minus total liabilities, the owner's equity is nothing but the net worth, that basically already we know. So, in this case, if you go by this, your NW, which is considered as the net worth is equal to total assets minus total liabilities. Though if you want to calculate the change in net worth, then obviously it is nothing but the change in assets minus change in the liabilities. Your delta represents the change in value. Your change in the net worth is nothing but the change in the value of the assets minus the change in the value of the liabilities. So, that basically already we know. And what is the duration gap in this case? Duration gap is calculated in this way. If you can calculate your duration of the assets, this is the duration of assets minus some weight into W into DL. And what is this W? W is basically nothing but your total liabilities divided by the total assets. This is the weight. And why there is a difference between total liabilities and total assets? That is, the difference is nothing but the equity. How much equity the particular bank is holding, that basically is the difference between the total liabilities and total assets of the commercial bank. So, accordingly, if you know your DA here, if you see your duration gap is equal to DA minus WDL, and your W is nothing but the, already I said that it is TL by TA. TL represents the total liabilities, TA represents the total assets, and DA is equal to the average duration of the asset, and DL is equal to the average duration of the liabilities. Then from there we can find out the once we get the duration of total assets and duration of the total liabilities, then we can find out the dollar gap, because total assets and total liabilities data we have. If you see in this case how basically this works, if you see this example, it is a simplistic example whatever we have taken. Let this is a balance sheet of a commercial bank. This is a balance sheet, although all the items are not considered. Already you know that in the asset side we have many, we have investments, we have loans, we have fixed assets and other kinds of thing. We have not considered those. We have here we have taken a very simple example. Let in the asset side we have considered cash, we have considered business loan, and also we have considered the other loans. We have taken loan as the major assets of this particular bank. So, in the liability side we have taken the certificate of deposits, one of the instruments, and we have the fixed deposits. And in the third column, if you see that we have reported the duration of this particular different type of instruments on the basis of the maturity. All of you know that the cash has no kind of maturity period, that is why the duration is 0. Then if you talk about a business loan, let the depending upon the maturity period of the loan, your duration varies. Let for the business loan is a relatively short term in nature, we have considered here. So, that is why we assume that the duration is let 2 years. For other loans, let the house loans and other loans which are relatively long term in nature, then here we have taken the average duration is 6. Whatever assets they have, the average duration is 6. So, for certificate of deposits, the maturity period we have considered very less, relatively short term maturity period. That is why the duration we have considered 1 year, and for the fixed deposits which are relatively long term in period, we have considered that the duration is the 6 years. So, in this case what basically we have seen that your total assets become 1500 plus 400 plus 100, your total liabilities become 800, 400 plus 400, and the company or the particular bank has equity of 200. then the total become 100. Because the liability is also we can say that equity also a liability, but we have it is not rate sensitive or there is no such kind of maturity period for that we have basically separated it from the other type of liabilities whatever we have. So, that is why we have 1000 here also 1000 because that should be matched. Then already we know that we have to find out the duration of that particular all the assets and we have to find out the duration of all the liabilities. Already the duration of the individual assets are given and how the weight should be given? The weight should be given on the basis of the proportion of that particular value of that particular asset which is existing in that particular system. Now, your cash is 100, then obviously what is the proportion? The proportion is 100 by 1000, then obviously it will be 10%, 0.1, right. Then we have the business loan which is 400, then it will be 0.4 which is nothing but the 400 by 1000, and for other loans it is 500, then 500 by 1000, that is 0.5. And now what we do? We know the duration of individual asset. So, 10% or 0.1 into 0, anyway that will become 0 only, plus 0.4 into 2, 2 is the duration of the business loan, plus 0.5 into 6, it is the 3.8 years. If you add up, it will coming, the weighted average become 3.8 years. In the same way, we are calculating the liability side. In the liability side, for the certificate of deposits, we have the 400 and duration is 1. For fixed deposit 400, duration is 6. Then total liabilities in terms of certificate of deposits and the fixed deposit, it is 800. Then obviously, your this is effectively 50%, 50% because we have not considered the equity. So, this particular proportion has to be made on the basis of the liabilities with respect to this other instruments, not equity is a part of that. So, because of that our proportion is 400 by 800, that is 0.5, here it is 400 by 800, 0.5. Then your duration of the liabilities has become 3.5 years, 0.5 into 1, 0.5 into 6, that become 3.5 years. So, now your duration of asset become 3.8, your duration of liability become 3.5. So, if you want to calculate the duration gap from this, already we know that duration gap is what? Duration gap is your dA minus W into dL. So, if dA minus W into dL we are talking about, your W is equal to total liabilities upon total assets, and here liabilities means it is apart from equity. So, here if your liability become 800 divided by 1000, so obviously it is 0.8. So, our duration of assets was 3.8, 3.8 minus 0.8 into 3.5 which is the duration of liabilities, that has become 1 year. So, the duration gap for this particular bank considering this balance sheet has become 1 year. So, now how this particular duration gap is going to be used, that is basically our focus. So, once you got the duration gap, we have to what we have to find out from this? There are two things we are trying to find out. How will the value of the assets and liabilities and the value of net worth, sorry, this is not net worth, this is you read it net worth. How will the value of assets and liabilities and value of net worth change as interest rate changes? Because here we are mostly concentrating on the value of the equity. So, the value of equity is nothing but a net worth, that already we know. So, you read it net worth, it is TH, and the effect of changing interest rate on the net worth is related to the duration gap. And how the duration gap is related to the net worth, that basically we have to see. So, in this context how basically this mechanism works, that is basically our objective. So, that interest rate, duration gap and the value of equity, if you want to establish a relationship between these three, then we already know that change in the net worth is equal to your change in the assets minus the change in the liabilities, your delta A minus delta L, your delta A minus delta L, that already you know, delta A represents the change in the total assets, value of the total assets, and delta L represents the change in the total liabilities. So, that is your delta NW. So, here the delta NW, if you want to relate it with respect to the duration, then this is the way basically this works. Now, how this works? Your delta NW is equal to minus dA, dA means duration of assets, into your delta I means change in interest rate, plus 1 plus I. The 1 plus I is basically what? The I means it is the original interest rate or the original discount rate which was there before, into A, the total assets. Then minus duration of the liabilities into same your delta I divided by 1 plus I is the original discount rate or original interest rate, into L, right. So, this is basically the difference, and why we are talking about this, your minus dA into delta I by 1 plus I, because already you know the duration is nothing but it is the change in the value of this particular asset with respect to that particular change in the interest rate, that already we know. So, here we are aggregating that particular thing. So, your delta A by A, which is basically change in the assets to the total assets, is nothing but the product of the asset duration times the change in the interest rate. The logic is basically brought from the definitions of the durations. So, the durations basically nothing but your delta P by P is, whenever we are talking about, we try to find out the first order derivative of this particular price, then we get this duration from this. So, using that concept already you know that your delta A by A is nothing but minus dA into delta I by 1 plus I, and here your A, if you are trying to find out delta A, which is nothing but multiplied by A. So, like that your delta L by L is equal to minus dL into delta I by 1 plus I. Then now, if you are multiplying delta, you are finding the delta L, then that basically has to be multiplied with L there, divided by into 1 by L means it is into L. So, because of that, the net worth of the particular bank is linked to the duration of the assets and liabilities through this way. On the basis of the concept of the duration, that relationship has been established. So, already I have explained these things. The change in the value of the net worth is equal to your average duration of assets into change in the interest rate divided by 1 plus original discount rate into total assets, minus the average duration of liabilities into change in interest rate divided by 1 plus original discount rate into total liabilities. That already what we have written here and we have explained it here. Through that, we are trying to establish the relationship between the change in interest rate, which is your delta I, your interest rate in today's period, that is I, then your duration of the assets and the duration of liabilities and the net worth. So, this is the way the particular relationship has been linked, or the duration and the value of the net worth are basically linked. Other way, the other formula for this same thing you can calculate also, the delta NW, which is the change in the net worth, divided by the total assets is nothing but the duration gap minus the duration gap into delta I by 1 plus I. Then obviously, your delta NW is equal to minus your duration gap multiplied by delta I by 1 plus I into TA, which TA means total assets. So, either you can directly go from here, you can previous case what we have seen, that is basically it talks about the relationship between the durations of liabilities, duration of assets, and as well as the interest rate and equity. From there, we can also directly find out your change in the your delta NW by TA is equal to the minus of the duration gap into delta I divided by 1 plus I. So, here what we are trying to see, or if you directly you are trying to find out your delta NW, your delta NW is equal to minus the duration gap into delta I by 1 plus I multiplied by TA. So, either you can directly use that one where the duration of assets and duration of liabilities everything will be used, or you can also go by this way for establishing the relation, how the duration of, if you know the duration gap, then you can find out how the net worth is going to be changed if there is a change in the interest rate. Using the same formula, if you are continuation with the previous example or the balance sheet whatever we have taken, let us assume that there is a 1% change in the interest rate and the original discount rate or the interest rate was 11%. So, if you are going by the longer formula, then you can find delta NW is equal to minus 3.8, minus 3.8 is the DA, your minus 3.8 is the DA, 1% is the change in interest rate, 1 plus I means it is 11% which is the original discount rate, your into A means is the total assets, that is the 1000, minus of duration of liabilities, that is 3.5 in our example. Same thing, delta I is equal to 1%, 1 plus I is equal to 1.11, and your liabilities we have considered 800 apart from the equity. So, then what we get, that it is minus 3.8 into 0.009, that is 0.01 by 1.11 into 1000 minus this, then finally what we got it, that is 9. Your net worth will change by 9 million rupees if your interest rate will change by 1%. If it will increase or decrease, depending upon that, your net worth will also increase and decrease. So, if you are directly using your, already we know that your duration gap from this particular example was 1. So, directly we can use it minus 1, minus of the duration gap into delta I divided by 1 plus I, that is your 0.009 into your total assets, that is basically giving you the 9. So, both the cases you can get the same answer because that is derived from there only. So, you have to remember this one, which will be in the easier way we can use it, that minus of the duration gap multiplied by the delta I divided by 1 plus I, that means change in interest rate divided by 1 plus discount rate multiplied by the total assets. That will give you the how the change in a net worth is going to happen, or delta NW. Now, we can see that what kind of observations we can draw from this. If interest rate will increase, the value of the net worth will decline. So, when the interest rate is going to increase, the value of the asset would drop more than the value of the liabilities. So, the value of the net worth drops. So, whenever the interest rate basically increases, the impact of that particular interest rate on the value of the assets and the impact of that particular interest rate change on the liabilities are not same, these are different. So, for the rising interest rate, the value of assets should drop more than the value of liabilities, than the value of, then thus the value of the net worth drops. But whenever there is a changing fall in the interest rate, the value of the assets would rise more than the value of liabilities and the value of the net worth would increase. So, whenever there is a declining in the interest rate, the value of the net worth increases, and whenever there is a declining in the interest increasing in the interest rate, the value of the net worth declines. This is the implications, what basically observations we can draw from here. So, here in this case also, like your dollar gap analysis, we can have also defensive and aggressive duration gap management we can do. Whenever we can go for a defensive gap management, duration gap management, here in this case what we are trying to do? We are trying to make or keep our value of equity intact or same. So, whenever we are talking about this, what basically we are trying to do? We are trying to make your duration gap 0. So, in this context, if you can make your duration gap 0, then what happens that any change in the interest rate is not going to affect the change in the net worth. That basically we can judge, already we have seen also whenever we have discussed about the dollar gap. But if you are going for an aggressive strategy, here in the aggressive strategy what we are trying to do, first of all in the aggressive strategy we have to anticipate the interest rate movements, how the interest rate is going to move. So, our objective is if the interest rate is going to increase, then obviously our net worth is going to decline. If the interest rate is going to decline, then our net worth is going to increase. That also depends upon the dollar gap, the duration gap. So, depending upon the positions of the duration gap and as well as the prediction of the interest rate, we have to make some kind of adjustment with respect to the structure of the balance sheet. So, that is the basic objective. So, for example, if the duration gap is positive, the interest rate is going to increase, the net worth is going to decline. The duration gap is positive, interest rate is going to decrease, the net worth will increase, that already we have seen. But the duration gap is negative, but interest rate is increasing, then your change in net worth also is increasing. And if duration gap is negative and change in interest rate is declining, then net worth is declining. It is just reverse to the observations what we got it from the dollar gap, where we are trying to establish the relationship between the dollar gap and the net interest income. And another one is 0, whether the increase or decrease, that does not matter. That means perfectly the interest rate risk is nullified due to the composition of the assets and liabilities, and that strategy sometimes we call it the immunization strategy in the market, where we are trying to, whenever there is any fluctuations, anyway that particular fluctuations in the interest rate is not going to affect the value of the net worth or the value of the equity of this particular bank. So, first of all, already what we have seen that whether you go for, if you are going for a defensive strategy also, we have to make a lot of adjustment with respect to the balance sheet to make your duration gap equal to 0. If you are going for an aggressive strategy also, it is more complex in nature, because first of all we have to predict the interest rate, and once the interest rate is predicted or can be anticipated, then accordingly depending upon the market conditions, interest rate scenarios, our duration gap has to be maintained accordingly. That means, if the interest rate is going to increase, we have to make our dollar gap negative. If the interest rate is going to decrease, then we have to make the duration gap positive. So, that basically we have to keep in the mind. And how the duration gap can be made positive or negative, that already we know that we can reduce or we can increase the maturity period of the different type of assets and liabilities what the commercial banks are holding. So, these are the strategy what basically we follow whenever the duration gap and net worth relationship is established to minimize the interest rate risk in the market, or if there is a change in the interest rate, how we can basically immunize ourselves to ourselves for the fluctuations with respect to the fluctuations of the total net worth of the banks. If you see the conclusion, what we can see that the duration gap is a measure of interest rate sensitivity that helps to explain how changes in interest rate affect the market value of the bank's assets and liabilities and also the net worth. For rising interest rate, the value of assets would drop more than the value of liabilities, thus the value of net worth also drops. And for falling interest rate, the value of the assets would rise more than the value of liabilities and the value of net worth would increase. And another also thing we have observed from there, that whenever the dollar duration gap is negative, if there is interest rate is increasing, then the net worth is increasing. But if the dollar gap if the duration gap is positive, if there is a declining in the interest rate, then the net worth is increasing. So, what basically the banks try to do, if they are predicting that the interest rate is going to up, then they want to make their duration gap negative. If they are predicting that the interest rate is going to be down, then they want to make their duration gap positive. So, that is the strategy what basically they want to adopt if they are going for the aggressive strategy, or if they do not want an aggressive strategy, they want to make your duration gap 0. So, in that particular condition also they make this particular adjustment in terms of balance sheet items like both assets and liabilities, which finally can make this dollar gap the duration gap 0 by changing the maturity period. Because at end of the day, once the maturity period of the different assets changes, the duration of the different assets and liabilities also will change. So, accordingly you can the commercial banks can make this particular duration gap 0, which is perfectly immunized from any kind of interest rate fluctuations in the market. So, these are the references what you can go through, and further we can discuss about more the other kind of analysis which are used to manage the different kind of risk in the commercial banking system. Thank you.